Hello, I'm here to talk to you about major changes that are currently happening in Japan, both in the economy and in financial markets. For about 30 years, Japan has suffered under deflation, and this has meant that companies and individuals have tended to hoard cash. So rather than putting it to work in stock markets, or companies putting it to work through capital expenditure to grow their businesses, they've basically just kept cash, knowing that the yen that they had would be worth more, could buy more the following year. Since the end of COVID, Japan has moved from deflation to inflation, and this is a very powerful driver in a number of ways. First of all, it's increasing the possibility of corporate earnings growing. Second, it's making investment in the stock market more attractive both to companies and to particularly individuals. Japanese households hold approximately 50% of their net worth in cash at the moment, and that's very high. In Europe, the number's 35%, and in the US, 20%. We expect the new inflation that's happening in Japan to bring some of that household wealth, and there's a lot of it, into the equity markets. The second thing is that corporates have been loath to increase capital expenditure, and they're now starting to ramp up capital expenditure plans again after, as I say, 30 years of really having very low spending. What that's doing is transforming the outlook for earnings in Japan, as companies are going to make investment decisions which mean that return on equity, revenues and margins grow. The second thing that's important is a revolution in corporate governance. Both the government and the Tokyo Stock Exchange are putting pressure on companies to improve corporate governance, and by this, to improve their price-to-book ratio. The price-to-book ratio and the return on equity in Japan has been historically very low, about half that for the US, for example. And one of the reasons for that is because deflation meant it wasn't worth spending money on new developments. And what we're starting to see now is those developments ramp up. What we're also starting to see, though, is that Japanese companies, which have long been hoarders of cash, are starting to put that cash to work, and if they can't find capital expenditure or research and development opportunities, they're giving it back to shareholders. And this is one way that they're improving their price-to-book ratio and their return on equity. And that looks very good. There's a lot of upside for Japanese companies. And return on equity, particularly from a Lazard point of view, is one of the key measures we look for when we're looking to invest in companies. The third thing is this change in Japan is making it look much more attractive to global investors. For 2 decades, global investors have been removing money, disinvesting from Japan. And so they're very underweight. And Japan still is the world's second largest stock market, but they're very underweight, they're very overweight US. And we think there's a natural situation arising where global investors will put money to work in Japan that previously would perhaps have gone into US equities in particular. That in itself, together with the households, together with capital expenditure, mean we expect lots of money to be heading into the Japanese market going forward. The final point is that valuations in Japan, which in the 1980s when I started my career were 4 times what valuations were in the rest of the world, have fallen over the last years because of deflation to a situation where they're now about 3/4 of the valuation of other major markets. And we start to expect those valuations to rise as money comes into the market and as the return on equity earned by Japanese companies also rises and makes them more attractive. So we've got companies which are going to do very well, much better than they have. We've got return on equities rising. We've got a lot of cash coming into the market, and we've got relatively low valuations. All of that speaks very well to the attractiveness of Japanese equities right now. And you'll also notice that all of these things are domestic factors. Although tariffs have obviously raised their head over the course of this year and become a major issue for investors in the short run, we think they're just that they're short-run noise. And they're changing and leading to opportunities in share prices as companies react to that short-term news. But in the long run, Japanese equities are very well founded and very attractive.